Good morning, members of the FOMC. Today's staff presentation reviews current macroeconomic conditions, forecasts and risks, and our policy recommendation. Data-dependent monetary policy involves taking stock of current developments in economic activity, inflation, the labor market, and financial conditions.
Let's start with economic activity, which remains resilient despite tariffs and policy uncertainty. Real GDP increased at a 3.8% annual rate in Q2, as strong consumer spending and fewer imports outweighed declines in investment and exports. Additionally, non-farm productivity increased 3.3%, consistent with elevated gains since 2023.
While AI-related capital expenditures have supported investment, growth remains broad-based. Real final sales to private domestic purchasers rose 2.9% in Q2, highlighting robust private sector demand. Additionally, consumer retail sales and expenditures both beat expectations at 0.6% in August, with broad gains since June. Consumer delinquency rates, which have been rising since 2024, appear to have peaked, while personal savings rates have been revised upwards, suggesting that the household balance sheet may be more resilient, a trend that could support future growth in consumer spending.
The business outlook remains uncertain. Consistent with Baker et al., continued policy uncertainty likely weighs on investment. However, regional manufacturing signals are trending upward from April low, supported by resilient AI CapEx across many industries and upcoming tax policy encouraging investment in 2026. The growth outlook remains strong. GDP now and nowcast projected Q3 growth of 3.9% and 2.3%. Uncertainty remains elevated, so we acknowledge a wider than usual band of forecasts.
Next, we turn to inflation, which remains elevated. In August, year-over-year PCE and core PCE rose 2.7% and 2.9% respectively, up 0.3 to 0.4 percentage points from the April lows. Similarly, year-over-year CPI and core CPI have risen to 3.0% in September. Recent upticks in inflation have been driven by several factors. First, goods prices, which were declining last year, have begun to rise, likely reflecting tariff-induced price pressures and the unwinding of prior overstocking by suppliers. In particular, tariff-exposed durables like consumer electronics and appliances have posted significant monthly gains. The Yale Budget Lab estimates that core goods and durables were 1.9 and 2.3 percentage points more expensive, respectively, than their pre-2025 estimated trends in June. And Cavallo et al. Estimate that tariffs have added 0.7 percentage points to the headline CPI in the 6 months ending in August.
Core services inflation remains sticky. The Dallas Fed estimates that, excluding imputed non-market prices such as portfolio management, core services PCE has steadily hovered around 3% since May 2024, driven by strong consumer demand and elevated labor costs. In particular, the 3-month average of median hourly wage growth was at a 4.1% annual rate in August, down from 2022 highs, but above pre-pandemic averages.
Shelter remains a key but lagged driver of inflation. Shelter CPI rose 3.6% year-over-year in September, down from 4.0% in April. However, the year-over-year Zillow rent index has already normalized to pre-pandemic levels. Ball & Co. argue that shelter CPI lags market rents because rents are smooth for lease renewals, most existing rents are set in long-term leases, and rent changes are measured every 6 months.
Distributionally, the New York Fed's economic heterogeneity indicators show that current inflation gaps have narrowed compared to 2021 to 2022. Additionally, Hispanic, Southern, rural, and middle-income households have all seen lower inflation than the national average.
We now turn to the labor market, which has been characterized by gradual cooling in both supply and demand. The U3 unemployment rate rose to 4.3% in August, the lowest level since 2021. Monthly non-farm payroll gains averaged 29,000 over the last 3 months before revision, well below the 12-month average of 118,000.
Labor demand has eased. Non-farm vacancies reached a 6-month low in July and a 10-month low in July, and the vacancy to unemployment ratio has declined to below 1 for the first time since April 2021. In addition, the hiring and quits rates are near historical lows. That being said, the recent rise in unemployment has been driven mostly by new entrants and re-entrants' difficulty finding jobs rather than existing workers being laid off. Businesses have slowed hiring, but appear to be largely retaining workers amid uncertainty.
Diminished job-finding prospects have hit young and less educated workers hardest. Unemployment for 16 to 24-year-olds is up 1.5 percentage points since January, versus 0.2 for prime-age workers. And unemployment for workers with less than a high school diploma spiked to 6.7% in August. Moreover, Black workers saw the steepest year-over-year increase in unemployment in Q2.
Labor growth has also slowed. The LFPR slipped to 62.3% in August, and the employment-to-population ratio is at its lowest since 2022, though their prime-age components remain near historic highs. Slower immigration is also weighing on labor force growth. Net migration is expected to decline in 2025, and BLS data indicate a 1.1 million decrease in foreign-born workers since January. More broadly, marginally attached and discouraged worker counts have steadily risen. Overall, we see a low hiring, low firing environment with labor supply decreases and uncertainty weighing on the current softness.
Finally, we turn to financial conditions, which moderates the transmission of monetary policy into real activity. Broader conditions have loosened this year. After an initial spike in April, the Chicago Fed's National Financial Conditions Index now currently indicates that conditions are more than a half standard deviation looser than their historical average, driven largely by fallen risk premia. Additionally, the board's FCIG index now indicates that conditions are a tailwind to growth.
The percentage of domestic banks tightening their lending standard has slightly increased for large and mid-sized businesses in 2025, especially after a Q2 spike post-tariff. While bank lending conditions have tightened, private credit continued to scale as a lending channel, totaling $1.3 trillion in mid-2024, more than twice its 2019 level. At the same time, the high-yield bond spread has narrowed by 150 basis points to 3%, below the historic average of 4.2%. As such, financing conditions remain loose, reducing the urgency for lower rates to support lending. However, the dollar has depreciated 8% year-to-date, while the gold has increased 45% year-to-date.
Looking at key rates, the yield on 10-year treasuries has declined more than 60 basis points since the beginning of the year to around 4%. Mortgage rates have also declined but remain elevated. The average 30-year fixed-rate mortgage dropped to below 6.3% in October. Commercial real estate risk has slightly moderated given high recent transaction prices and elevated occupancy rates. At the same time, equity markets remain exceptionally strong, with the S&P 500 index repeatedly reaching record highs.
We now turn to forecasts and our weighing of the risks of inflationary persistence against further labor market weakness. Inflation risk is sustained by continued tariff pressures, sticky service prices, and potential de-anchoring of expectations.
First, tariff pass-through remains incomplete. Cavallo et al. Estimate that tariffs pass-through to consumers is currently 20%. Boston Fed research suggests importers plan to pass through about two-thirds of production cost increases. Compared with 2018, tariff pass-through is likely slower due to policy uncertainty and larger inventory buffers. Additional tariffs could further elevate inflation risks.
Tariff pass-through appears to be affecting non-importers as well. Cavallo et al. Show that non-importer sectors' prices have risen to match affected sectors, suggesting that firms are either raising their markups due to newfound pricing power or are passing along elevated input costs to the consumer. Additionally, the BLS Import Price Index has only slightly risen since April, suggesting that foreign firms have yet to meaningfully absorb the cost of tariffs. Though tariffs' effects on inflation can be transitory, Cuba Borda et al. Find that they can persist when intermediate inputs are affected.
Second, non-housing services inflation, covering half of consumer spending, remains high at 3.3% with little sign of decline. This is consistent with sticky wage growth still above the pre-pandemic level. With strong wage gains and upcoming fiscal stimulus ahead, upward pressure will likely persist next quarter.
Third, inflation expectations risk becoming de-anchored. Surveys from the University of Michigan, the Cleveland Fed, and the New York Fed all report one-year consumer expectations that have significantly increased. That being said, longer-term market expectations remain closer to target, with five-year break-even inflation hovering around 2.4%.
We now turn to the employment mandate. First, labor market weakening may accelerate. Job gains have been concentrated in a few sectors, mainly private education and healthcare. Excluding the latter, monthly non-farm payroll gains have been negative in 3 of the last 4 months.
Furthermore, with historically low hiring, an increase in layoffs can have outsized effects. Indeed, the beverage curve has moved down since 2022, so further vacancy declines could raise unemployment more sharply. Worker expectations have also worsened. The New York Fed estimates that the mean perceived probability of finding a new job if laid off is currently 47.4%, near pandemic lows.
Second, retaliatory tariffs or potential new export restrictions, such as recently proposed tariffs on steel by the EU, could further hurt U.S. exports. Third, Londono et al. Find that inflation uncertainty itself is associated with precautionary behavior that weighs on investment and demand.
However, there are 2 factors that temper our view. First, economic growth and consumer spending remain resilient, and wage growth is stable, suggesting that the recent payroll softness may partly reflect supply-side factors such as immigration outflows. Recent research by the Dallas Fed suggests that break-even employment decreased to around 30,000 in mid-2025, dramatically lower than the peak of 250,000 in October 2023.
Second, Nugent and Silla note that firms tend to reduce job postings during periods of elevated uncertainty, particularly for high-skilled, costly-to-reverse roles. Thus, current softening may reflect temporary uncertainty more so than structural weakness, and we may soon see labor market data align with relatively solid GDP readings.
We now turn to our policy recommendation. When weighing inflation against unemployment risks, policy errors are asymmetric. Over-tightening can generally be quickly reversed if the labor market deteriorates, but inflation de-anchoring and credibility loss from over-loosening are far harder to correct.
Thus, our recommendation is as follows. For the December FOMC meeting, we advise the committee to hold the target FFR at its current level of 3.75 to 4.0%. On the balance sheet, in line with the October decision, the committee should maintain the current size of the balance sheet while reinvesting principal payments from agency securities into treasury bills. Regarding a communication strategy, the committee should communicate a data-dependent approach incorporating labor markets development.
We prefer holding to cutting for 4 reasons. First, the risk of inflationary persistence remains salient. Core services PCE remains above target, and continued tariff pass-through could keep price pressures elevated for longer.
Second, expansionary fiscal policy, asset price increases, and concerns over the Fed independence have also led to more sensitive expectations. Given perception of the committee's delayed response to pandemic-era inflation, a serial error in timing current inflation may de-anchor expectation and significantly damage credibility. Recent research by Nakamura et al. Suggests that only highly credited central bank with long records of stable inflation can afford to look through temporary inflationary shocks.
Third, the unemployment rate remains near historical lows. Some of the recent softening reflects supply-side shocks, and a resilient economy continues to provide support. Moreover, high-frequency labor market indicators haven't seriously deteriorated since August. For example, the Chicago Fed's nowcast puts the unemployment rate at 4.35% in October, the layoffs rate up 0.01 percentage points, and with initial and continuing claims largely steady. As such, we believe that the risks to the labor market currently outweigh inflation risk and credibility risk.
Finally, it is debatable how restrictive policy is at 3.75 to 4%. While the SEP places R star near 1%, other estimates hover around 1.5 and 2%. Post-pandemic factors, sizable fiscal spending, smaller trade deficits, AI-driven investment, and wealth effects likely have raised R star. Furthermore, loose financial conditions and robust growth further suggests that rates may be closer to neutral. An additional cut could be unduly stimulative given persistent inflation risks.
We agree with the committee's October decision to cease balance sheet runoff. The ONRP has fallen to $14 billion from a $2 trillion peak. The EFFR IRB spread has narrowed, and standing repo usage has increased, all signs that liquidity pressures are building. To limit intervention in mortgage markets, the committee should continue replacing agency MBS with treasury bills on the balance sheet.
Beyond the December meeting, there are 3 facets of the economy that we recommend the committee pay close attention to. First, the committee should be particularly sensitive to jolts and claims data that suggest that firms are moving from a great stay towards active workforce cuts.
Second, inflation and its components should be closely monitored. Greater tariff pass-through, lasting input prices increases, or stickier services inflation could suggest that policy rates should stay higher for longer.
Finally, if both inflation and employment seriously deteriorate, we may find ourselves at risk of stagflation. While the committee should carefully weigh both sides of its dual mandate, we believe it should be especially cognizant of the high cost of potentially having to re-anchor inflation expectations.
In conclusion, while both inflation and unemployment risks remain, the current situation favors holding rates steady. Thank you. We look forward to your questions.
Thank you for your presentation. We have a couple questions for you. First, we've seen monthly job gains move sharply lower this year relative to last year's period, while at the same time, the unemployment rate has only moved up a bit. How are these observations consistent, and what are the implications for monetary policy?
Yeah, thank you for the question. So as you mentioned, the non-farm payroll number decreased a lot, but the unemployment rate rose slightly a little bit. So firstly, I will touch on why the non-farm payroll numbers decrease is lesser concern than we thought it would be. There are 2 temporary reasons. Firstly, we have seen immigration outflow. We have seen immigration net outflows around 1 million less than what we had before, and that may imply that supply side factor we need less job to keep the unemployment rate at a steady level. And second, we also seen that RFPR has a historic trend of trending down post-pandemic. We have seen that after the pandemic, the older people RFPR has decreased. A lot of the people choose to leave the employment market after the shift.
Yeah, and I'll also add that there's been a lot of questions about the validity or sort of accuracy of jobs data recently. So we had a recent paper by Becker et al. In 2024 that talked a little bit about how the births deaths model is kind of 1/3 of what we're sort of using to impute for job gains over the past few years, and it's even increased closer to 2/3 recently. And so a lot of the model itself, we've kind of had lowering response rates, especially for new firms, or kind of further relying on the births deaths model. And so as a result, these numbers have potentially become a little bit more volatile, in addition to sort of this decrease in the break-even rate that's driven primarily by labor supply factors.
Yeah, and I will also make a very quick point that there's research by Bloom et al., which shows that after periods of high uncertainty, the labor markets tend to rebound very quickly. So that's another reason why we tend to be a bit less worried about the labor market right now.
And the final thing I would add, just to update for the September jobs report, is that most recently we saw monthly non-farm payroll gains at 117,000 in September. And so that would imply that perhaps payroll gains could be trending upwards. It does also mean that with regards to the break-even rate, though, that despite the increase in 117,000 jobs, we did see unemployment still tick up by 0.1% to 4.4%. When we're looking at the data, we see a decrease in the marginally attached workers, which we mentioned in our advocacy as trending upwards. We saw a decrease of around 400,000 and a corresponding increase of 0.1% in the labor force participation rate, which could imply that the one way to interpret the data would just be that we see a greater labor force participation. So we would say that to put it all together, we think break-even has definitely come down from where it has been post-pandemic, from around 200,000. It probably could be a little bit higher than the 30,000 estimate from the Dallas Fed, but is probably somewhere in between there.
Yeah, and I'll very, very quickly add to your last part of the question in terms of implications for the Fed. If we think this is primarily a labor supply driven softness in the labor market, then you can imagine that the Fed's sort of monetary policy that primarily works through the labor demand channel will be generally less effective. So that itself sort of makes us a little bit more worried about how significant cutting will do in terms of stimulating the labor market.
Thank you. We're going to shift to financial conditions. How should policymakers take into account signals from financial markets, such as stock valuations and credit spreads, when deciding on the appropriate stance of policy? This is a two-part question. Second part, if changes in financial markets have different implications for monetary policy and financial stability, how should policymakers weigh the trade-offs?
Yeah, thank you for the question. So for the first part of your question, we think that central banks should take into financial condition only insofar that it affects our dual mandates. We do think that financial stability is a prerequisite to achieve this dual mandate. So to put in context of our current situation, we are seeing that stock valuation is really high, and we shouldn't think about we should pay less focus on whether this is actually overvalued or undervalued. What we should pay focus to is that stock market is probably an input to aggregate demand, because when people's wealth are up, they tend to spend more, and that's general robustness in the aggregate demand may mean that inflation is likely to stay higher for longer and labor may rebound.
Yeah, and so I'll add, kind of build off of that. There's been sort of a debate in terms of whether the Fed should lean against the wind. There's papers out there talking about predictable financial crises. This was Greenwood et al. Sort of talking about how you can sort of predict a financial crisis. And now the question is, when we think that asset price valuations are kind of ballooning, should we lean against the wind? So Svensson 2017 talks a little bit about two channels of why leaning against the wind may sort of be a problem. So one, you can imagine that if we lean against the wind and there isn't actually a bubble, which is sort of unclear right now since it's sort of early in sort of the AI boom currently, you can imagine that economic growth will be lower than it otherwise would have been. On the other hand, you could also imagine that given the long and variable lags in monetary policy, if you sort of hike now to try to prick the bubble and the bubble bursts very soon, then the contractionary effects of this hike might hit you when the economy needs to necessarily be kind of expansionary. So as a result, what Svensson finds is that you would actually need a hike in the rate to actually be 5 to 40 standard deviations higher in terms of reducing the probability of a crisis than current literature estimates. So we, as a team, sort of don't really move towards this idea of leaning against the wind currently.
Finally, I'll just touch on kind of two short points. The first is that I don't know if we've kind of seen a bifurcation in financial conditions in the sense that we've seen like very resilient AI capex. We've seen a lot of private credit, and indeed, like credit spreads are very tight. At the same time, I think mortgage rates are particularly elevated. I think consumer delinquencies for like credit cards and auto loans have also increased, though they've stayed steady in the last couple of months. And so there is the sense where you can kind of interpret it in the sense that like policy might be like slightly restrictive, kind of because like rates that are being like encountered by like consumers as businesses are kind of high, but also in a sense that like some of the investment we've seen has also been occurring like despite the fact that like policy is restrictive, in the sense that we expect kind of the rate of return on like AI capex and like data sensors to be like extremely high. The second thing that I'll also note is that it might be potentially that a decent amount of kind of investment or like loose borrowing is also an expectation of kind of like future rate cuts. Like if we think that a lot of borrowing right now predicated on long rates bakes in kind of expectations of the path of rate cuts, then one implication we might have for the Fed is that if we were to embark, for example, on contractionary policy, if we were to say, okay, we're going to focus completely on inflation, that might kind of like, it might be like a shock to kind of our path of expectations. And so generally, we don't necessarily think that the committee should make decisions basically completely in line with market expectations. We think it definitely has to prioritize the dual mandate, like my colleague Yafen mentioned. But we do have to be cognizant of the fact that moving in the opposite direction of market expectations might significantly change people's kind of investment, lending, and borrowing decisions.
Yeah, and to address very quickly the second part of the question on how should the Fed think about financial stability in terms of policy, we think that the Fed should be very predictable in the way it conducts monetary policy. And so on that note, balance sheet management becomes very important. We saw examples in the past, like in 2013, the taper tantrum, or in 2019, where the Fed let run off a bunch of securities, and that sort of freaked out the markets. And so the Fed had to later step back in to purchase new securities in order to rebring stability into the market. So we think that the most important thing is that the Fed conducts monetary policy and especially balance sheet management in a very predictable way. And that's why we advocate in our presentation for stopping the runoff of securities in the balance sheet of the Fed.
Thank you. I would like to follow up on this last answer you gave on something that interests me very much about the balance sheet of policy. Can you explain me or elaborate further on which pieces of data have led you to your current recommendation of holding the balance sheet purchases? Yeah. And then what would you need to see, what changes on the data do you need to see in order to change your recommendation?
Sure, yeah. I think my colleague wants to add something, yeah.
Sure, so I can start off on this. So in May of 2022, the committee decided that it would begin its policy of quantitative tightening, i.e. running off and decreasing the size of its balance sheet. The reason for this is to kind of counteract the large wave of quantitative easing we got in the preceding years. You're right in that in October, the committee has decided to keep the size of the balance sheet constant. A couple of quantitative indicators that people looked that indicated pressure in kind of short-term lending markets. It was the case that kind of like money market rates began to kind of rise in relation to administered rates. So we saw the EFFR IRB spread decrease about 4 basis points, I think, in the last 8 months. We saw that use of the standing repos facility from the Fed increase significantly. And we also saw ONRP balances draw significantly down from like that peak of $2 trillion to $14 billion, which suggests that a kind of further quantitative easing was going to start eating into the level of bank reserves. We can even look at kind of spreads in like SOFR to IORB, the tri-party repo rate to the IRB. These are all of these rates happen to be increasing, suggesting pressure in these markets. We can even look at the New York Fed's kind of reserve demand elasticity, a kind of indicator, which tells us that we want to be at a piece of the balance sheet at which reserve demand is inelastic to kind of our administered rates. And so at the point where the elasticity is starting to deviate from zero is the point at which we should probably consider stopping our quantitative tightening. Oh, and then one other point about whether to continue like QT. I'll just make the 2 points that firstly that there's a natural growth in non-reserve liabilities, so like currency over time, and there's also a natural growth in the demand for reserves as kind of like the financial system grows. So I think as like Roberto Perli and like John Williams noted, the New York Fed, eventually we're going to start increasing the size of kind of the balance sheet. This might come in the next couple of weeks, in the next couple of months, but we're going to have to see whether these quantitative measures that I kind of just laid out kind of stay the same, whether they alleviate, or whether they get worse.
Thank you. Thank you very much.
Okay, thank you for that answer and the clear presentation. I want to come back to a point that you mentioned in presentation, namely about the beverage curve. So you stated that further declines in vacancies may lead to higher unemployment at this point. Well, we have seen a lot of declines in vacancies over the last couple of years without any changes in unemployment. So what has changed?
Thank you for the question. I think one thing that I'll say very quickly, so the reason why we're kind of shifting down the beverage curve is that we started at a point in which unemployment was very low and there were a lot of vacancies because the labor market was very tight, kind of rebounding from post-pandemic. We think that if the economy is cooling or labor demand is cooling, the first kind of margin of adjustment is to reduce job postings and to reduce vacancies. And so now the fear is that, if labor demand were to cool too much, or if we to have a kind of too restrictive policy, then we might see kind of a nonlinear, kind of a sudden increase in the unemployment rate. The first thing that we'll say at the top is that we think it's unclear as to whether labor demand will continue to cool. We think this is kind of a function of the amount of uncertainty of the economy and how prolonged that's going to be. If we think of the labor market as a relatively low hire, low fire, then kind of our assessment, firstly, our assessment kind of hinges on the probability that we're going to see kind of a mass layoff event. We think that growth has been relatively broad-based. If you look at the contributions to kind of GDP growth, it's been spread across kind of business investment, even by both in category and also by sector. We think that consumer spending is relatively robust, so we kind of think the probability of kind of dislocation on the unemployment front is not particularly high.
Yeah, and so given that we sort of see, significant movements in uncertainty and sort of this low hiring, low firing environment, it's sort of hard to sort of pin down where we kind of think the kink in the beverage curve is, whether we believe we're sort of at the point where, previous data would suggest that when we're at sort of V over U equal to 1, you would expect that we're kind of at that kink and over time greater decreases in vacancies leads to higher increases in unemployment. But it's very difficult for the Fed to kind of only rely on these models given how the economy has significant uncertainty, significant movements in labor supply, significant changes sort of across economic growth. So it's very difficult for us to just kind of use the beverage curve as just one main thing that we're kind of basing our policy off of. It's more of kind of an indicator of hey, there's potentially greater risks to the downside of labor market right now, but given the other data that we've shown you, given the labor supply ideas that we've talked about and uncertainty, we generally believe that the labor market and levels is generally strong, and we're not necessarily worried about a very quick deterioration of the labor market given the beverage curve.
And to touch on the structural layoff of your question, you mentioned that in the past, the vacancy has decreased, but unemployment hasn't spiked up that much. And we think that structurally, there is a few changes in the labor market. Firstly, there might be a productivity change. As we see in the couple of years, there are a lot of emphasis on increased productivity by adopting information processing technology. And because of that, the firm might just need less workers to keep the same amount of output. And that might be one structural change. And the second structural change might be a general shift in the economy towards a more less labor-intensive sectors. So, for example, in the past, we might rely on manufacturing, but now maybe people are putting more money into the tech and AI, etc. And this change in the GDP and the composition of the growth might lead to the discrepancies that you lay out, which is vacancy in the past decreased a lot, but unemployment has remained roughly where it is.
Thank you.
You suggested in your presentation that the Fed should have a different stance towards agency MBS than treasuries and balance sheet policy. Can you talk a little bit more about that recommendation?
Yeah, for sure. I think there are two things that we think are positive developments. The first is that the Fed should have relatively small quantities of agency MBS or anything that isn't directly U.S. kind of sovereign debt. The reason why is that if the Fed were to kind of persistently hold these types of other assets on the balance sheet, and they're consistently generating a source of demand in kind of MBS markets. And we don't think that MBS or whether it's kind of any other kind of debt market should be kind of necessarily prioritize one or the other. So basically we think it's a matter of intervention is artificially creating demand for MBS. The second thing we think is a positive development is that to our understanding, kind of the rollover of the balance sheet in keeping the size of it constant is going to be basically across the yield curve. They're going to make an effort to do this. We think this is also nice because we don't think, so for instance, the principal payments from agency MBS are going to be reinvested in mostly bills, my understanding. And so we think that's also nice because we don't think the Fed using its balance sheet should be kind of interfering with the shape of the yield curve. So we think that like the size of the balance sheet and maintaining it, okay, yeah.
Thank you very much for your
Thank you.
presentation.
Thank you.